CNBC-TV18 Motilal Oswal Studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant, with me, my colleagues Sonia and Suvi. Guys, hi, morning.
Hi, good morning. Hi, morning. A brand new day.
Green today again.
Yeah.
I don't know if it'll last, Prashant. That's the question.
I should have worn a green tie.
You know, I thought that there's so much, the market is so dull, it's so boring, so let's spice it up a little bit by, wearing some color. It automatically cheers up your mood. So
that is
I don't know if it's going to cheer up the market's mood. That only time will tell.
Yeah, absolutely. But I think we've got some green, right, to start with, in the US especially. And I think let's take what we get, basically. That's the position that we find ourselves in. Let me just quickly run you through what happened overnight. There was a bit of a relief rally in US stocks. NASDAQ actually ending about 2.25% higher. The S&P 500 a little less. It's basically pulled back at the day's high to the 200-day moving average. That's point number one. Now, the bank index, right now, it's not to say that this basically shows you that all the troubles in the bank sector, financial sector is behind. But prices, markets price things in very fast. So we had the broad KBW bank index, which was up 3%, and the KBW regional bank index ETF was up 2%. So this is the troubled part of the market, which itself is starting to see a little bit of pullback. We had the big data point, which is the CPI number, the consumer price inflation in the US, which is still running hot. The core CPI came in higher than what was expected. The headline was in line. What does that mean? It basically means that the Fed's job is not done. Core CPI, and by the way, people like economists at Citi, etc., are saying that this February CPI, core CPI number shows that the number is going to run strong for several months. So basically, the Fed's job is not done, which means more rate hikes have to come, which means yields have to reprice themselves. So they did. And the table will come up on your screen. Look at the yield curve, 2-year, 5-year, 10-year. These are gigantic moves, but the fact is this is only a fraction in terms of reversal of what we saw the moves day before. We had 50 basis point in terms of a move on the 2-year, and we reversed about half of it, and from 4% we went to about 4.24%. How do the market pricing, this is market interest rates, right? But the market pricing of what the FOMC in March will do has not changed much. It moved up about 5 basis points. Market is saying in March, on 22nd of March, FOMC will hike by 20 basis points. Terminal rate about 5%, but there will be rate cuts in the second half of the year. So this is still a very conservative pricing in light of the stronger than expected core CPI numbers. And you can blame this, or you can kind of thank this and kind of give thanks to the financial sector troubles. Markets have been fragile. Now, the point is there is still a few days to go between now and the Fed meeting. What happens if markets kind of see more relief rallies and the index goes up another 5-6%? Things will look very different. Markets rallying are financial conditions easing, which then will allow the Fed to do a little bit more. So things will be fluid. I mean, keep that in mind. Now, coming to sort of the local market here, we've seen a 700-point fall, right? I mean, in the last 3 sessions, that's 4%. That's a very large fall that we really saw. In that regard, I think we'll be deserving of a pullback. Sometimes when the momentum is very strong, very oversold conditions can be ignored, but not for very long. I would say in the very near term, watch for the Nifty to trade above the 17,220 level. It's a sort of technical level. By the way, the market got to 17,220 and then exactly from that point sold off. So that's let the market trade above this level for some time before you decide to take long trades. This is, of course, from a trading perspective. A similar level in the Bank Nifty is to watch for the Bank Nifty to get past the 39,740 level. And once it kind of shows you willingness to trade above this, I think you decide to go long, at least test the waters with some long positions. From a slightly more sustainable basis, we need a positive daily close, which is possible we get today after what has been a pretty tough last 3 sessions. Sonia.
I thought you'd say a pretty tough 2023, right? I mean, the year so far has been what? The Nifty has lost 7% this year already.
Yeah.
It's down 10% from its 52-week high. So forget about the tough last 3 days. It's been a tough year. Hopefully things will improve. But, even if the pullbacks come, right, as you were saying, I mean, a lot of things have improved overnight. There's a lot of green across the screen. But even if the pullbacks come, they could be shallow. That's because if you look at the texture, it is very weak for the market. It's been 4 days running now that the Nifty has been under pressure. As I said, it's down 10% from its 52-week highs. It's down 6.5% this year already. And there's been large FI selling yet again. So yesterday as well, FI sold about 3,000 crores. It's 3 days running. We've had a 4-digit figure in terms of FI selling. And now in the last 4 trading sessions, over 7,000 crores has been pulled out by FI. So the screen is not looking good. Even if you get a pullback, it could be very shallow. At the same time, I don't think it's a right time to short this market either. So in that context, perhaps wait and watch is something that you could do. A lot happened overnight. Despite the Dow seeing a recovery, there are some negative signs. Moody's cut their outlook on the US banking system to negative. You had a big fall in Brent, by the way. Brent is now at a 3-month low of $78 a barrel. So there are demand concerns there too. And a couple of levels that I'm watching out for on the index itself. The next level will be the September 2022 low of 16,818. That was a level we were watching yesterday as well. We're still a little bit away from that, but if the sell-off resumes, which it could, I mean, things could go either way. There is a pullback today, but it could get sold into. Next level to watch on the downside. And on the upside, the 200 DMA of 17,400 to 17,450 is acting as a key resistance. The important point to remember is this: although the US CPI inflation data has cooled off to 6%, it is still well above the Fed's targeted inflation rate of 2%. So there's a lot of work yet to be done for inflation control. And in that context, things could go either way in the March 22nd meeting of the Fed. So all in all, yes, there is some green, but whether it lasts, I'm not too sure.
I guess that's the million dollar or the billion dollar question, right? But just to reiterate some of the points, Prashant, you mentioned, I think if we hadn't had this entire SVB incident, then what the CPI numbers have done between the jobs report and the CPI number, I mean, you started off with expectations of a 50 basis points rate hike on the 22nd. Those expectations have been pruned down to 25 basis points. I mean, that's what's happened. But then we had a mini bank blow up, 2 banks blowing up in between. So that's the first point, that the inflation number.
How you call it mini bank blow up.
And the mini bank blow ups, right? I mean, thank God we didn't get to anything bigger than that. So $200 billion in asset, maybe the market, wants to digest that and just move on. And that's what the mood seems to be like today. That's the CPI data. The market also ignored what Moody's said yesterday, and maybe the market has good reason, because a lot of the rating agencies were pulled up for being way behind the curve back in 2007 and 8. But for what it's worth, I mean, I'm just quoting what Moody's saying. They said so they've changed the outlook for the entire banking sector, by the way, not just 1 or 2 banks, the entire US banking sector, from stable to negative. And they're saying that the outlook change reflects a rapid deterioration in the operating environment following the failure of SVB, Silvergate, and Signature Bank. The market completely ignored that. The market wanted to, latch on to relief and get a relief rally going, and that's what happened. There was also some geopolitics. By the way, there was a drone, and there was confusion between whether it was shot down, and then it came to light that it was a collision. But basically, you have drones up in the air, and it was a US drone that finally went down. But again, the market moved on beyond that. The market was in the mood to latch on to that relief rally. So let's see if that can play out today. In India, additionally, apart from all the global cues and the yields, I'll watch out for Reliance, quite a bit. We have some news, and we'll get Rima to give us more details on this. Interesting stuff happening. It seems that Reliance wants to make deeper inroads into the premium segment with their postpaid plans. They've announced some new plans. Let's see if that moves the needle on the stock, because the stock has been an underperformer. It's actually down more than the Nifty this year. Nifty is down about 5.5–6%. Reliance is down well over 10% this year. So is Reliance poised for a bounce, for maybe a bit of a short covering, if nothing else? If that happens, we know that's excellent for the market. And likewise, I'll watch out for the banks once again. And we had some evidence come in yesterday. Yesterday, the Bank Nifty did not fall as much as the Nifty. So the next level that I'll watch out for is the 200 DMA. The Bank Nifty is just below the 200 DMA. It broke that effortlessly in the decline. So can banks start seeing some money come back, and will some shorts start to cover? Tomorrow is the weekly expiry. So I think Reliance and banks put together will offer an interesting perspective from the bull standpoint to see if this can be a good bounce. Bigger question is, this market has become a sell on rally, as we say. Will the rallies get sold into? That was what was happening yesterday. We have today's couple of hours to figure out.
You know, just one more headline that everyone's talking about now is what's happened with Apple, right? They've decided to A, delay their bonuses, and B, limit their hiring. So once again, a hiring freeze on certain pockets. And that says a lot about how this A, funding winter is not over, and B, this layoff situation, right?
Meta.
I mean, it's been going on for a while and now it continues. So.
Forgot to mention Meta. I mean, Meta is, slashing 15,000 jobs, closing 5,000 open positions, and this is over and above the 11,000 cuts they did. But again, as
this is before the recession, impending recession.
You know, but I was reading somewhere that in terms of just the headcount, right, the total workforce in the US, tech constitutes these numbers are huge, and these are well-paying jobs, right? Relatively well-paying jobs. So the impact on purchasing power, demand, etc., perhaps is disproportionate. But numerically, it's a very small percentage. I mean, you know, if you when you look at the labor market numbers and you say, well,
like
we're seeing headline
sure.
after headline of layoffs, but the labor market number is still very strong because it's a small percentage of the overall pie.
Overall market. All right, let's kickstart the show. In fact, we have plenty of stocks to talk about as well this morning. So without wasting any time, first up on the equities front, we have Venugopal Gare of Bernstein, who says that until now, India's macro moderation does not place it as an outlier, and recent data suggests some acceleration in consumption and industrial demand. However, he adds, as China continues to see a recovery in activity and its rub-off effect is expected to benefit other ASEAN countries, the nature of the US slowdown will play a role in dictating the risk to growth this year. He says a hard landing in the US is not good for exports, and in that respect, India may end up holding better. But domestic risks such as weak monsoon, inflation impacts, and lack of macro buffers may still present a downside risk to the GDP forecast. He also adds what he sees for now suggests that India's underperformance with EMs in general may not persist for long, and a valuation correction could make him more optimistic.
Okay, that's on equities. Let's move to the money markets now, and here are some views coming in from Kunal Sodhani of Shinhan Bank. He says, in response to the US CPI report, the dollar index printed minor gains and yields rallied. He says Brent crude prices sharply cooled off, and core CPI rising month on month suggests that inflation is stickier than estimates. He adds that the dollar index remains under pressure, and it appears is still supported by recent lows of 103.5, an area coincident with the provisional 55-day simple moving average. Below the latter, Kunal says the dollar could slip back to the weekly low at about 102.58. For the USD INR pair, he says 81.95 acts as a support, while 82.55 is a resistance.
All right, and on the bonds, Neeraj Gambhir of Axis Bank says the 10-year benchmark bond yields traded in a range of 7.33 to 7.45% for the week. He says bond yields eased with curves steepening on account of global risk-off sentiment due to the SVB fallout in the US. He says India February CPI came in at 6.44%, in line with market expectations, and he expects the 10-year benchmark to trade in a range of 7.32 to 7.42% for the rest of the week, ahead of the US FOMC meet.
All right, we have plenty of stock-specific action lined up today that we will track for you as well. So in just a bit, we'll get our top 10 segment going. Today, we're looking at Maruti Suzuki, Reliance, LTI Mindtree, PVR, Voltas, RailTel Corp, PNC Infra, GMR Airports, and Dixon Technologies. All of those on the back of positive news flow. ONGC is the only stock on our radar that could perhaps open in the red.
All right, Mark Matthews of Bank Julius Baer and Company, and Gregory Deco is Chief Economist, Strategy and Transactions at Ernst & Young LLP, joining and around to take some questions. Gentlemen, great to have both of you here. Appreciate your time. Mark, let me start by sort of putting this to you. I mean, the dark shadow of the banking and financial sector turmoil perhaps is still focus number one for markets, despite the overnight relief rally. The question, though, is will this be contained, and hence will the market be able to put all of this behind, or will this fester and linger? And what's the impact for markets? Go on, Mark.
Prashant, I doubt that this is the last skeleton to pop out of the closet, but I think that what's going to happen is deposits will flow into big banks, and if you combine that with the fact that there's been an implicit guarantee for all deposits, including those above $250,000 for the entire industry, that's what really bailing out Silicon Valley Bank and Signature Bank infer. Then even if there are more skeletons and they could cause more turmoil, I think longer term, the big banks are fine. And in fact, I would say that what's happened is probably going to be a net benefit to them longer term.
Okay. Mark, good morning. Just one follow-up. You know, the ferocity of the fall that we're seeing especially in a market like India, is quite unnerving at the moment. I mean, the market has already lost 6% this year, and we're not even through the month of March. Do you reckon that there could be a larger downside coming as we head into perhaps what could be a large recession in the US? And if yes, what should the approach be now for investors?
Well, you know, of course, that equities are volatile, and I don't know the statistic for the Indian stock market, but I can tell you that on average, since 1950, the maximum intra-year drawdown for the S&P has been 14%, which is very big. And so could it go down more? Of course it could. But I think if we turned off our computers today and came back in 6 months, the market will be higher than it is now. Unfortunately, we don't have the luxury of doing that. Neither you nor I would have jobs 6 months from now if we did that. But you know the old saying that the best thing to do is to buy and hold good quality stocks, which I think dominate the Nifty index. So, yeah, could there be more downside? Of course.
Oh, but that's an interesting point, Mark, considering how this year started off, especially for us here in India. A lot of people were just saying that, okay, should we just write off the entire calendar year? But your perspective is quite interesting. You're expecting the markets to be better off 6 months from now. Gregory, let me come to you. Good morning. Thanks for joining in. How have you read all of this news flow and all of these events over the past couple of days? And would you share that view that eventually, in the next few months at least, you expect markets to head higher?
I think we don't know. I think we are in an environment where there's still a gradual realization from the private sector, in particular in the US, but around the world, that we are likely to be in an environment of a higher cost of capital for a prolonged period of time. As you were mentioning earlier in your introductory remarks, we are still in an environment where the Fed wants to continue tightening monetary policy, will likely adopt a dual track approach to tightening monetary policy. On the one hand, continuing to raise rates, and on the other, maintaining its lending program to help stave off some of the stress in the banking sector. So that will likely continue to play out over the coming months. And there is still uncertainty as to whether the US economy will head into a recession. I think the recent developments favor an environment where credit conditions tighten further, where financial conditions tighten, and where that puts downward pressure on economic activity.
Mark, the Fed meeting on the 22nd of March, how do you think that will go? Will we get a hike at all?
Yes, we're looking for 25 basis points. We had expected another 25 in May. Now we're just saying one in March, and that's it. And that's basically because we think that, to Gregory's point, the credit activity, the economy is decelerating. There is a lag impact of higher rates, and the Fed would be, we feel, adopting a more mindful approach in light of what's happened with Silicon Valley Bank, et cetera.
You're saying this is, Mark, this is the last one? This is the last hike in this cycle?
Yes, and then we're looking for cuts in the second half.
Wow. So, you know, all the calls of terminal rate, you know, at 5.5, 5.75, there are still mainstream economists who have that at 5.5, 5.775%.
Well, I think there's a risk if they tighten a lot more that the economy goes into a recession, and there are a lot of Republicans in the Fed, but I don't think they want to see Donald Trump elected next year.
Gregory, what is your own assessment of which way things could go? Are you as well looking at just a 25 basis points rate hike and done? And what is the expectation as far as the Fed's 2% inflation target goes? What kind of a timeline are we looking at?
Well, I think we are certainly in an environment where the discussion next week is likely to factor in what has happened on the banking sector front, and therefore will likely be between either holding at the constant rate or increasing by 25 basis points. Had there not been banking stress, 50 basis points would most likely have been on the table. I think we have to be very careful because the market sentiment pivots very quickly. And if this situation is contained for now, we could see the Fed continuing to signal its intent to raise rates more aggressively than just one additional 25 basis point rate hike. Let's not forget, a week ago, markets were pricing in an additional 100 basis points of further Fed tightening, and the Fed and Fed Chair Powell have a strong desire to avoid having a legacy of having let inflation run out of control. So there will be likely a lean towards a more hawkish stance. And I think that's something that we'll see being repriced into markets in the coming days.
I'll surely make the 22nd meeting ever so interesting to find out how the Fed is kind of perched at this point. But Mark, quick last question to you. Even if we get a slightly more dovish, or should I say less hawkish Fed, if the underlying economy is slipping into this recession, do you still expect equity markets to rally?
Yes, in fact, most of the time the economy and the market are inversely correlated. And if you look at the years that had negative growth in the past, 3 out of 4, the stock market was up anyway. So to answer your question in short, I'm not too concerned about the economy decelerating.
All right, not concerned about the economy decelerating. There's a 25 basis points rate hike perhaps coming at the March 22nd meeting, and time to be a bit cautious, although you can continue to latch on to the large cap stocks in the index. Got that. That's the summary of the discussion we had. Mark and Greg, thanks a lot for joining in and helping us through what has been a really volatile phase for the market the last many days. Let's take a quick break. On the other side, our entire team will be joining in to help us with the top 10 stocks that you need to watch out for as we begin a brand new day of trade. Good morning. Welcome back. You're watching Bazaar Morning Call. We have our entire research team joining in now to help us prep for the day. Plenty of stocks to talk about, so without wasting any time, lots happening in the telecom space. RelGeo is in focus. Rima's here to give us the latest on that. Rima, over to you.
Thanks so much for that. So Reliance Jio has announced new postpaid plans. So first, for the family plan, which basically means for 3 or 4 people. Reliance Jio has introduced a Jio Plus family plan which starts at $399, and if you want an additional SIM, you can get 3 additional SIMs for 99 rupees each, which means for a family of 4, you would be paying 696 rupees, so a little less than 700 rupees. This is the cheapest available plan in the, what is available right now. So in that sense, some people believe, some of the analysts believe that Jio is now getting aggressive. Right? Everyone was hoping for a tariff hike, but here you have Reliance Jio coming out with the cheapest available family plan. But if you compare like to like, which means the same benefits, then Reliance Jio has a higher value plan for almost 1,000 rupees, 996, where not only will you get 4 SIMs, but you will also get access to OTT, which is what the other competitors are offering, like Airtel and Vodafone Idea. So those plans are comparable. So like to like, it is comparable. Reliance Jio has also introduced an individual plan. Now, earlier, the cheapest individual plan available for Jio was $199. This compared with $399 that Bharti Airtel had. So nearly 50% off Bharti Airtel. But now for new subscribers, Reliance Jio has gone ahead and increased the tariff, and now the new tariff plan will be $299. So here they're not getting aggressive. They've in fact, in a way, initiated a tariff hike increase. So all in all, the question is, with these permutation combination, can they succeed in postpaid? In prepaid data segment, they've made a big dent. They've captured a very large market share. But in postpaid, despite offering plans cheaper than peers over the last few years, Reliance Jio has not managed to garner a subscriber share because those subscribers are less price sensitive. So will this make an impact? That's something which remains to be seen now.
Okay, that's a very interesting one, and definitely something to watch for, of course, Reliance Jio. And of course, we'll watch for Bharti Airtel as well and see what the reaction is like. Thank you, Rima, for that. Sonia, you're watching for Maruti Suzuki. There was some interesting action on the stock front yesterday with the promoters hiking stake.
The parent company, Suzuki, yes, they've hiked stake in a very small fashion. So what they've done is they've bought about 3.5 lakh shares in Maruti for worth about 300 crores from the open market. And with this, their stake, in any case, they have a majority stake of over 56%. Now it goes from 56.37 to 56.48%. Now, Suzuki had last bought stake in Maruti way back in June of 2020. And as we know, stake increase from promoters generally bolsters the confidence in the stock. And hence, I'm expecting the stock to be in the green. Now, what could be the reasons? Why is the Suzuki increasing stake? There are a couple of reasons. Now, the first electric vehicle from Maruti stable will be launched in FY25, and Maruti has big plans in the EV space. They plan to introduce 6 electric vehicles by FY31, so that's the big positive trigger to watch. Also, Suzuki has already announced capex of over 10,400 crores for the electric vehicle business and battery manufacturing in Gujarat. So they are expecting demand to pick up in the EV space in a big way. Of course, we all know that Maruti is a bit late in the game, but now the entire EV space is, thriving. So hence, Maruti will be able to benefit from all of that. Some of their new launches have also done very well. So the new Grand Vitara has seen a very good response. The Jimny, the Fronx, all of that will bolster Maruti's presence in the UV space and help them regain market share over there. Citi put out a note where they said that Maruti is now their top pick in the auto sector. There are 2 reasons for that. One is that the market share perhaps has bottomed out and it's only northwards from here. And second is the new UV models will definitely help them bolster their market share. So I'm going with green on that stock.
It's a topic for Citi. Maruti here in India is also the top pick for Suzuki. Globally, right? In all the markets that they operate in. I mean, I think very clearly this is the focus market for them. Well, LTI Mindtree held an investor day. Rima is here with the key takeaways and what was said. Rima, hi, morning.
Hi, so LTI Mindtree held its first analyst meet after its merger with Mindtree. It was held by the CEO, Debashish Chatterjee, who outlined the strategy, and he also indicated that the merger between LTI and Mindtree is now completely over. He reiterated that in the next 4 to 5 years, the merged entity will realize revenue synergies of $1 billion and cost synergies, which will help improve margins by 200 basis points. This is not new. They had indicated it earlier, but this has been reiterated. On macros, he did indicate that clients are a bit cautious. Deal conversion is taking time, but the large deal pipeline remains quite robust. It amounts to $3.2 billion for LTI Mindtree. 55% of their revenues is unaffected by the macro uncertainty. They also disclosed that SVB was a client, but the revenue contribution was very, very minimal. Back to you.
Okay, so not too much of concern there from that call, it seems. Thanks for that, Rima. Let's go across to Surabhi. Surabhi, you're watching for a couple of stocks. Which ones?
Hi, thanks for that. So today I'll be watching at 2 con calls, PVR and Voltas. PVR Inox had held their first con call as their merged entity yesterday, and there the management has said that they will be adding 200 screens every year for the next 2 years, and they aim that the 40% of these new screen additions will come in the southern part of India. The management expects the EBITDA synergies to be in the range of 200 to 225 crores, and they expect it to realize that in the next 12 to 24 months. In the longer term, they expect to drive synergies from additional F&B revenues, ad revenues, and also rationalizing their operational cost. They've also gone ahead and said that they will derive 5% of their spends per head from their food delivery business. Now, most brokerages have a positive view on the stock. CLSA and Nuvama both have a buy rating. The takeaways from the Voltas management meet was also quite positive. They have said that due to the early onset of summer, the room AC sales to channel partners in the month of Feb have been pretty strong. The secondary market share in the month of Jan has been maintained at 19%, and they expect to see further improvement in that. They may take price hikes in month of April depending on the secondary market demand. And on the EBIT margin front, they have said that they expect it to remain at single digits and they should touch 9% in the near term. On Waldbeck, they plan to launch more SKUs in the near term, and they expect the expansion of the distribution channel to increase by 1.5 times by FY24. Nomura has a buy rating on this stock with a target price of 1,083.
All right.
Go on, Sonia.
No, I just wanted to mention that, Surabhi, thanks for that. I just wanted to mention on Titagarh Wagons, they've won, they've emerged as the lowest bidder for this railway ministry order. This is on the back of that Vande Bharat order that they had announced a while back as well. So this is an additional order that they've won. So it's another stock to look at. I mean, on the Vande Bharat order, they had said that the first train will be delivered in 24 months, and they also spoke about how there's a upfront revenue potential of 7,500 odd crores when they supply the first train. now there is this new order, 15.5 lakh forged wheels. So I guess that'll be another stock to watch today.
Absolutely. I mean, when railway infrastructure, one of the things has been, people always ask, well, which are the stocks, what are the bets to take on that theme? And there have always been these stocks listed for the last 2 decades more. But because orders are patchy once a year, once in 2 years, they've been, stocks have also been very, very patchy. Pick up around the railway budget, which of course doesn't exist now. But I think with Vande Bharat now, there is a steady inflow of orders which we are starting to see. And that program of Vande Bharat, I think, will only be expanded in the coming months and years. All right, let's move on. Vivek is standing by with more stocks with news flow. Vivek, hi, morning.
Well, good morning. Quite a few stocks on my radar today. A lot of news flow post-market as yesterday. First on the list is Raintel. The company has got a work order of over 287 crore. Now, this is for development of IT infrastructure in both New Delhi as well as Bangalore. We also have to keep an eye out for PNC Infra. The company has emerged as the lowest bidder for an NHAI project. Now, this is in the state of Bihar, and the company will be developing the project under the hybrid annuity mode, and the project cost is worth around 1,260 crore. Keep an eye out for GMR Airports Infra as well. The company is looking to raise funds. Now, the fundraise could be either via the QIP route or the foreign currency convertible debenture route as well. So this particular stock too will remain in focus. Lastly, keep an eye out on Dixon Tech. Now, newspaper reports that we have not independently identified have reported that the government has cleared an other tranche of PLI scheme. Now, the incentive is worth almost 765 crore. Dixon Tech is eligible for over 150 crores here.
All right, thanks a lot for that. So lots of stocks in focus. Here's a quick recap in case you missed out on any of them. Stocks with positive news flow. All right, before that, we also have to talk about the way crude has been moving. It slipped to $78 a barrel, and now it's seen a minor bit of recovery. So Manisha Gupta is joining in to give us a quick update on that. Manisha, good morning.
Thank you for that, Sonia. Well, yes, we have seen the crude oil prices extend decline by 5% in the overnight markets. A percentage point higher is how it's trading right now, but that is because the banks have the bank shares, that is, have staged a bit of a recovery. The global equity markets are off their lows, and that clearly seems to be supportive many of these commodities as well. But having said that, trading below $80 a barrel, this is the lowest since December 2021 that we have seen in sense of crude oil prices. For this week itself, we are down by 6%, and for the month down by 8.5%. The markets are still looking at contagion fears and global recession concerns. That is expected to weigh onto the prices. While OPEC says that they are expecting high oil demand from China in this year, the markets will also watch out for the Chinese industrial production numbers that comes in today. And of course, it is the US PPI, retail sales, all of that also coming in today. So the markets are expected to be continuing to be choppy.
Okay, thanks a lot for that. That's on the commodity space. But in the equity space, the SGX Nifty is indicating that the start will be well in the green. In fact, high point of trade right now on the SGX. But as promised, here's a quick recap of all the stocks that you should be watching out for today. On the positive side, there's Maruti, Reliance, LTI, Mindtree, PVR, Voltas, Railtel, PNC Infra, GMR Airports Infra and Dixon Tech. While the only stock on our radar with negative news flow this morning is ONGC. So watch out for that. But take a quick break. On the other side, Deven Choksi of KR Choksi will be joining in for some fundamental stock analysis. We'll also connect with Ajit Venkatraman of Finolex Industries to discuss their business outlook. Stay tuned.
Welcome back. Let's keep the conversation going. Time to get some fundamental ideas into this market. Deven Choksi of KR Choksi is with us for exactly that. Deven, good morning. Great to have you on the show as always. I want to kick it off by talking telecom because we've woken up to this news of some interesting developments. Jio making more inroads or trying to make more inroads into the postpaid side of things with this new family offering. I think it's an aggressive pricing they've gone in for. How do you expect things to play out? And what is your call on both the stocks, Reliance as well as Bharti?
Yeah, Surabhi, good morning. Well, I think as I understand, this family offering plans is largely to capture the customers which are basically going to be utilized for the 5G network. In a family offering plan, I think the larger amount of offering is also included along with the data. So data share has been given, which is a significant amount of, I think, incentive for the family to shift over. In my viewpoint, I think you have the only two ways in which I think you can possibly, grow this entire business. One, keep on adding additional customers, And on the other side, I think keep on having a higher amount of usages, which would possibly mean that your revenue and the profit would drive the activity faster. I guess I think on a 1 lakh crore kind of a revenue book, about 50,000 crore EBITDA, this is the run rate that the company has already achieved. And as this particular plan is launched, I believe that I think they hold the power of compounding at the rate of 20%, I think, on this particular run rate. So obviously, down the line 4 years, you are likely to see the size of the book getting doubled to 2 lakh crore, and I think the EBITDA to getting around 1 lakh crore. So this is where I think the entire equation is set based on the numbers that we calculate as a part of, I think, this launch that they have done.
Okay. Devin, hi, good morning. A smaller segment, but a segment definitely in the news is this entire railway piece, right? I mean, we just heard about Titagarh Wagon being the lowest bidder now for an Atmanirbhar project. Earlier, they bagged that Vande Bharat project as well. From an investor standpoint, long-term investing, do you think if someone hasn't been able to capture this rally in railway stocks, now is not a bad time?
Yes, Sonia, good morning. Well, I think always there is a good amount of opportunity given the kind of spending the government is doing in entire infrastructure space, railways also included. So from that perspective, the higher amount of order book getting released for most of the companies, I think is a very welcome news. Only caution here is the buying at a price and a valuation, because in railways business, the margins are always watertight. And most of the companies could end up winning this particular contracts on EBITDA margin of between 5 to 7 or 8% at the most. Given that kind of challenge and given the kind of cost push kind of a challenge that they would have, giving any kind of a premium valuation to this company under the euphoria that they have won higher amount of orders, I think would be not rewarding for the investors. I would remain a little bit watchful on that particular aspect. Yes, in a fall, in the market fall like this, what we are currently seeing across the market, that gives an opportunity, because that is a time when probably you are getting valuation cheaper and the downside risk in these stocks are protected. So this is an opportunity at a lower price. Certainly, I agree with that part.
Devin, hi, morning. Bandhan Bank sold off some 5%. We reported yesterday they're looking to enter the insurance segment. The other microfinance, on the microfinance side, there have been worries, and the performance has been very patchy. Every couple of quarters, there is hopes of a turn, which has not worked out. So your views on Bandhan? And then the Adani Group stocks all reversed after many days of some relief and repair. So any thoughts there?
Hi, Prashant. Good morning. Well, I understand with the rising interest rate scenario, the liability side is going to be a troublesome activity for many of the NBFCs and including for microfinance companies. That's where probably I think they would face higher amount of challenge, because the cost of fund increases, and here the microfinance companies particularly, they enjoy higher amount of margin spread. If your cost of fund increases and if you're charging higher amount of margin, possibility of I think you building the non-performing assets in the book remains very, very high. And that is an area of concern. So maybe I think that's one of the things which I am not very comfortable. In fact, I always believe that I think given the choice, you have relatively better opportunities available into the larger corporate banks, so strong ability to manage the liability side well, and at the same time using the technology and the fintech at the front end, they have the better ability to expand their reach and adding into the quality of borrowers. So we remain more convinced about the corporate banks, and with the corrected valuation in some of the cases, they remain relatively more attractive play vis-a-vis the microfinance companies. Coming to Adani stocks.
Yes, go ahead.
Sorry. Coming to Adani stocks, which is your second question, I believe that I think the market is remaining extremely concerned at this point of time on various technical parameters which are emerging, nothing to do with the fundamentals and the profit prospects of Adani Group. They remain as convincing as they were before. I believe that I think the technical fabric of the market is weakening, and weakening, I think, very sharply. That is a concern also. Most of the traders are basically wanting to take an exit. It's an opportunity, mature is coming to them. Adani Group of stocks have risen, I think, from the lows, and they have recovered. So those who are stuck with the long position, they would find an opportunity to exit, I think, at a higher price. That is the reason for which I see the kind of fall that one has seen yesterday into the market.
Okay. In fact, just on Bandhan Bank itself, I take your point that in a market like this, I guess it's better to stick with some of the larger corporate-facing banks. Bandhan Bank has, in the last 3 months, lost almost 25% of its value, and that's in 1 month it's down 13%. So I think better to, even if you're sticking with banks, better to stay with the larger corporate banks. Take that point entirely. Let's do one thing. Let's also get a quick corporate voice in now. Finolex Industries has commenced commercial operations of the PVC fittings in its Pune manufacturing facility. Now, this facility has an annual capacity of 12,000 MT. Ajit Venkatraman, who's the CEO at Finolex Industries, joins us now to talk more about this development. Ajit, thanks a lot for joining in. You've commissioned this new plant, so tell us a little bit about it. What kind of growth and revenue potential do you see here? You've incurred a capex, I guess, of 100 crores. Is there any more capex that you would put on board for expansion? And from this plant particularly, what is the growth potential?
So, good morning. We are essentially in two major segments, agri and the plumbing and sanitation segment. And as a company, we are trying to focus more on the plumbing and sanitation. Agri, we are already strong. And this plant, which we have added just a few days back, will contribute significantly to the plumbing and sanitation business. This is a growing business and a more profitable business as well. And so we have essentially added 25% capacity to this. Looking at both agri and plumbing and sanitation segment, the industry as such, the pipes and fittings industry as such is growing at approximately 15% CAGR over the past 5 years. And we expect it to grow in the same rate. And plumbing and sanitation, we expect it to grow at a little bit higher rate, between 15 and 20%. And therefore, this is just in line to make sure that we are prepared for the growth.
So,
Ajit, hi, good morning. And last time you were on, I think in the middle of Feb, you'd said that plumbing and sanitation will be the growth driver. Could you tell us at full capacity utilization, how much will this plant add to top line?
So it depends. Again, commenting on the top line is going to be difficult because it's all dependent upon the PVC prices. Essentially, in terms of, it's much safer to talk in terms of metric tons. This plant adds about 12,000 metric tons, approximately 25% to our fitting capacity.
okay. So, Mr. Venkatraman, just to understand, how much do you see plumbing and sanitation contributing to your total revenue pie, since you're looking to scale up that business? If you could give us a mix, and what will that do to the margins? I guess the last couple of months have been a bit challenging because we've seen a decline at the EBITDA level and at the margin level. Do you see that reversing as you scale up this business?
See, it all depends upon the PVC prices. As you have seen till November, the PVC prices were quite volatile, and it was in a declining path. And typically in a declining price for PVC, you typically don't see retailers stock up. But that reversed in the month of end of November, early December. So if you see the volumes in the last quarter, I think all the pipes and fitting manufacturers did quite well in Q3. And we experienced our highest Q3 ever in terms of volumes in FY23. It's going to be difficult for us to keep up with that rate in Q4. What we are seeing right now is that the prices of PVC was reversing in terms of increasing. And over the past few weeks, we have seen that it has been steady or declining. So there is a certain degree of turbulence in the market. And we expect the growth in this quarter to be quite lukewarm.
Okay, just one very quick question. You have 1,300 crores of cash on the books. Any other plans, either in terms of expansion, acquisition, or will you just let the cash sit there?
No, as you see, we have just invested over 100 crores in this fittings plant. And also we are always on the lookout for expansion and making sure that we are ready for the future growth. So if it is not going to be utilized for CapEx, then it will be returned to the shareholders.
Okay, all right. Well, I'm sure the shareholders are going to look forward to that. Thanks a lot for joining in, and have a great day. Well, let's slip into a quick break. In just about 10 minutes from now, we'll have the pre-opening rates, so do stay tuned in for that.
Welcome back. The SGX has given up just a little bit, though the color is still very much green. We're talking about a 0.5% increase going into trade today. And most of the markets around our neighborhood are actually holding up fairly all right. The Hong Kong market's up almost 2%. Nikkei has got some green around it. And even some of the other markets like Korea are holding out well. So relief rally is what traders around the world are playing for. We'll take a quick break on that note. Back in just a moment with the pre-opening rates.